Chapter 6, Corporate Ownership, Equity Securities. In this chapter, understanding the types of equity securities, comparing common stock to preferred stock, calculating certain values for stock questions, equity securities, such as common and preferred stock, represent ownership interests in the issuing company. All publicly held corporations issue equity securities to investors. Investors love these securities because they've historically outperformed most other investments. So on average or above average in your case, stockbrokers sells more of these types of securities than any other kind. The Series 7 exam tests you on your ability to recognize the types of equity securities and on some other basic information. Although you may find that the Series 7 doesn't test you heavily on the info provided here, this chapter forms a strong foundation for many other chapters in this recording. I think that you'll find it difficult, if not impossible, to understand what an optional mutual fund is if you don't know what a stock is. Needless to say, even though this chapter is small, don't ignore it or it may come back to bite you. You've most likely taken the Series Industry Essential exam already. If so, as in other chapters, there's a certain amount of overlap of information. That's good news for you because you should have a decent grasp on some of the topics covered in this chapter. Mixed in throughout this chapter, I give you plenty of examples to familiarize you with the types of equity securities questions on a Series 7 exam. And I give you a quick quiz, the explanations. Beginning with the basics. Common stock. Corporations issue common stock as well as other securities to raise business capital. As an equity security, common stock represents ownership of the issuing corporation. If a corporation issues 1 million shares of stock, each share represents a 1/1,000,000th ownership of the issuing corporation. The market share of the common stock of a corporation is based on the worth or perceived worth of the company, the amount of the shares outstanding, supply and demand, and so on. Since stockholders are owners of a corporation, they are afforded certain rights. Preemptive rights. First right to buy shares of the company if issuing more stock, the right to receive dividends if declared, access to certain corporate books, annual financial statements provided by the issuer, not detailed financial records, voting power, and the residual claim on corporate assets. Since common stock is considered junior to corporations' debt and preferred stock, common shareholders would be the last to be paid in the event of corporate bankruptcy. Understanding the stockholders' voting rights. One of the most basic rights that most common stockholders receive is voting rights, although rarely corporations issue non-voting common stock. Non-voting stock may be issued by corporations to protect their board of directors, but it's not as attractive to investors who like to have some control over who's running the company. Most preferred stock, covered later on, is non-voting. When investors have voting rights, every so often the company may have some investors vote to change members on the board of directors. Although investors may be able to vote on other issues, the Series 7 focuses on voting to change board members. Because having all stockholders actually attend the annual corporate meeting to vote would be difficult, stockholders usually vote by proxy or absentee ballot. Statutory regular voting. Statutory or regular voting is the most common type of voting that corporations offer to their shareholders. This type of voting is quite straightforward. Investors receive one vote for every share that they own, multiplied by the number of positions to be filed on the board of directors or issues to be decided. However, investors have to split the votes evenly for each item on the ballot. For example, if an investor owns 500 shares and there are 4 positions to be filled on the board of directors, the investor has a total of 2,000 votes, 4 candidates times 500 shares, which the investor might split evenly among all open positions, 500 each. The investor votes yes or no for each candidate. Cumulative voting. Cumulative voting is a little different from statutory voting. Although the investor still gets the same number of overall votes as if the corporation were offering statutory voting, the stockholder can vote the shares in any way they see fit. Cumulative voting gives smaller shareholders, in terms of shares, an easier chance to gain representation on the board of directors. For example, if an investor owns 1,000 shares and 3 positions on the board of directors are open, the investor has a total of 3,000 votes. 1,000 shares times 3 candidates, which the investor can use to vote for any candidates in any way they see fit. Cumulative voting doesn't give an investor more voting power, just more voting flexibility. The only way to get more voting power is to buy more shares. The following question tests your ability to answer a cumulative voting question. Bella Bereshknoff owns 800 shares of CBA common stock. It's time for CBA to hold its annual shareholders meeting, and there are 4 candidates for the board of directors. CBA offers its shareholders cumulative voting. Which of the following are acceptable votes from Bella? 1. 800 votes for each of the 4 candidates. 2. 2,000 votes for one candidate and 400 votes for each of the other candidates. 3. 3,200 votes for each one candidate. 4. 3,200 votes for each of the candidates. A. 1 only. B. 2 and 3. C. 1, 2, and 3. D. 1, 3, and 4. The correct answer is choice C. Ms. Bella has a total of 3,200 votes, 800 shares times 4 candidates. Because CBA offers cumulative voting, she can vote the 3,200 shares in any way she likes. Statements 1, 2, and 3 are all correct because none of these choices require more than 3,200 votes. However, 4 will require 12,800 votes. As a side note, the question had asked about statutory voting. The answer would have been choice A. Categorizing shares corporations can sell. All publicly held corporations have a certain quantity of shares that they can sell based on the corporate charter. And these shares are broken down into a few categories depending on whether the issuer or investors hold the shares. Authorized shares. Authorized shares are the number of shares of stock that a corporation can issue. The issuer's bylaws or corporate charter, a document filled with the state that a document filed with the state that identifies the names of the founders of the corporation, the company's objectives, and so on. States the number of shares the company is authorized to sell. However, the issuer usually holds back a large percentage of the authorized stock, which you can sell later through a primary offering. Issued shares. Issued shares are the portion of authorized shares that the issuer has sold to the public to raise money. Logically, the portion of authorized shares that haven't been issued to the public are called unissued shares. Shares may be kept unissued for up to 2 to 3 years. Shelf registration for future use. Outstanding shares. Outstanding shares are the number of shares that are in the investor's hands. The quantity may or may not be the same number as issued shares. At times, an issuer may decide to repurchase its stock in the market to either help increase the demand and the price of the stock trading in the market or to avoid a hostile takeover when another company is trying to gain control of the issuer. The stock that the issuer repurchases is called treasury stock. The standard formula for outstanding shares follows. Outstanding equals issued minus treasury. The following question tests your understanding of outstanding shares. ZZZ Betting Corp is authorized to issue 2 million shares of common stock. However, ZZZ only issues 800,000 shares to the public. 1 year later, ZZZ repurchases 150,000 shares to increase the demand on the outstanding shares. How many shares does ZZZ have outstanding? A. 650,000. B. 800,000. C. 1.2 million shares. Or D. 1,850,000 shares. The right answer is choice A. You probably didn't have too much difficulty with this one. All the question is asking is how many shares are still outstanding on the market. Check out the following equation. Outstanding equals issued minus treasury. Outstanding equals 800,000 minus 150,000, which equals 650,000. Because ZZZ only issued 800,000 shares of the 2 million that it's authorized to issue, the most ZZZ ever had in the market was 800,000. However, a year after issuing those shares, ZZZ repurchased 150,000 shares, giving the company treasury stock. Therefore, the amount of outstanding shares is 650,000. Considering the per value of common stock, par value stated or face value for a common stock is not as important to investors as it is to bondholders and preferred stockholders. Par value for common stock is more or less a bookkeeping value for the issuer. Although issuers may set the par value at $1 or $5 or $10 or whatever, the selling price is usually much more. The stock's par value has no relation to the market price of the stock. The amount over par value that an issuer receives for selling stock is called additional paid-in capital, paid-in surplus, or capital surplus. The stated par value is printed on the stock certificate. It changes if the issuer splits his stock. An issuer can also issue no par value stock issued without a stated par value. In this case, the stock has a stated value that the corporation uses for bookkeeping purposes. A lack of par value doesn't affect investors. Splitting common stock was covered on the Security Industry Essentials exam, so you won't have to know the math related to splitting common stock on the Series 7. However, you should remember that forward stock splits lower the par value and the market value, as well as increasing the number of shares held by existing stockholders. Reverse splits increase the par value and market value while decreasing the number of shares held by existing investors. Sharing corporate profits through dividends. If a corporation is profitable and the members on the board of directors are in a generous mood, the board of directors may decide to issue a dividend to investors. Dividends are just a way for corporations to distribute cash, stock, product, or whatever out of its earnings and profits. If or when the corporation declares a dividend, each shareholder is entitled to a pro rata share of dividends, meaning that every shareholder receives an equal portion for each share that they own. The Series 7 exam expects you to know the forms of dividends an investor can receive and how the dividends affect both the market price of the stock and an investor's position. Although the investor can receive dividends in cash, stock, or property forms, stock of a subsidiary company, or sample products made by the issuer, I focus on cash and stock dividends because those sections are more likely. Those scenarios are more likely. Investors can't vote on dividends. Instead, the board of directors decides dividend payouts. You can imagine that if this decision were left in the investors' hands, they vote for dividends weekly. Even if the issuing corporation is profitable, it may decide not to pay a cash dividend to investors because it has other plans for the money, such as investing the money for new machinery, expansion, and so on. Cash dividends. Cash dividends are a way for a corporation to share its profits with shareholders. When an investor receives cash dividends, it's a taxable event. Corporations aren't required to pay dividends, however. However, dividends provide a good incentive for investors to hold on to stock that isn't experiencing much growth. Although cash dividends are nice, the market price of the stock falls on the ex-dividend date, the first day the stock trades without a dividend, to reflect the dividend paid. Stock price minus dividend equals price on ex-dividend date. Try your hand at answering the cash dividend question. ABC stock is trading for $49.50 on the day prior to the ex-dividend date. If ABC previously announced a 75 cents dividend, what will be the next day's opening price? A, $48.25. B, $48.75. C, $49.50. Or D, $50.25. The correct answer is choice B. $49.50 minus 75 cents equals $48.75. The math is as simple as that. Because stocks are now trading in pennies instead of eighths, just like they used to, calculating the price on ex-dividend date is a snap. Stock dividends. Stock dividends are just like forward stock splits in that the investor receives more shares of stock. Only the corporation gives a percentage dividend, 5%, 10%, and so on. Instead of splitting the stock 2 for 1, 3 for 1, or whatever. Unlike cash dividends, stock dividends aren't taxable to the stockholder because the investor's overall value of investment doesn't change. The primary reason for a company to give investors a stock dividend is to make the market price more attractive to investors. If the market price gets too high, it limits the number of investors who can purchase the stock, thus adding liquidity, ease of trading to the stock. The following question tests your expertise in answering stock dividend questions. John Johnson owns 40 shares of Wynn common stock at $33 per share. Wynn previously declared a 10% stock dividend. Assuming that no charge in the market price of Wynn prior to the dividend, what's John's position after the dividend? A, 400 shares at $30. B, 400 shares at $33. C, 400 shares at $36.30. Or D, 440 shares at $30. Answer you want is choice D. In this case, you can find the answer without doing any math. Because the number in shares increases, the price of stock has to decrease. Therefore, the only answer that works is choice D. I can't guarantee that you'll get a question where you don't have to do the math, but don't rule it out. Scan the answer choices before pulling out your calculator. Anyway, here's how the numbers work. You have to remember that the investor's overall value of investment doesn't change. John gets a 10% stock dividend, so he receives 10% more shares. Now John has 440 shares of WIN. 440 plus 40 shares. 400 shares plus 40 shares. 10% of 40, 400. Next, you need to determine his overall value of investment. 400 shares times $33 equals $13,200. Because the overall value of investment doesn't change, John needs to have $13,200 worth of WIN after the dividend. $13,200 divided by 440 shares equals $30 per share. John's position after the stock split is 440 shares at $30 per share. Corporate spinoff. Corporations sometimes decide to spin off a position of their company to create two distinct companies. They would typically do this because they feel that the companies will be stronger separated. An example of this is eBay. In 2015, eBay spun off PayPal Holdings, Inc. Investors who are holding shares of the parent company prior to the spinoff will receive shares of the new company equal to the percentage ownership of the parent company. Consolidations. Consolidations happen when two or more companies combine to form a new company or entity. The idea is for the new company to be able to gain more market share and possibly have more buying power. And some of the additional benefits might be the merging of expertise or technology. Unlike mergers, where typically the larger company absorbs the other, consolidations may result in a new company altogether. If this happens, stockholders will receive shares of the new company based off of their percentage ownership of one of the companies prior to the consolidation. Penny stocks. Penny stocks are low-price equity securities issued by corporations. Penny stocks are non-NASDAQ equity securities that trade over the counter at less than $5 per share. Penny stocks are considered extremely speculative in nature and aren't for everyone. Prior to contacting a client about the purchase of penny stocks, you must determine the investor's suitability based on information about his objectives and financial situation. All broker-dealers who trade penny stocks must provide a penny stock disclosure document, which outlines the risks of investing in penny stocks, lack of liquidity, price quick price changes, and so on, to investors prior to effecting any penny stock transactions. The broker-dealer must receive a signed and dated acknowledgement of receipt of the document from the customer. Certain established customers are exempt from having to receive and sign the disclosure document. The broker-dealer must wait at least 2 business days after sending the document to the customer prior to any penny stock transaction. Broker-dealers must maintain the customer's signed acknowledgement. In addition, if requested by the customer, the broker-dealer must provide the penny stock information provided at the SEC's website. Compensation. Prior to effecting the transaction in penny stocks, associated persons must disclose orally or in writing the amount of cash compensation they will receive as a result of the transaction. In addition, it must be sent to the customer in writing at or prior to the time the confirmation of trade is sent. Note: any customer holding penny stocks must receive a monthly account statement indicating the market value, number of shares, issuer's name, and so on. Exempt penny stock transactions. Under SEC Rule 15G-1, the following penny stock transaction will be exempt. Transactions by a broker or dealer whose commissions, markups, markdowns, and commission equivalents from penny stock transactions did not exceed 5% of its total commissions in the preceding 3 months and during 11 or more of the preceding 12 months, or the preceding 6 months, and who hasn't been a market maker in that particular penny stock in the preceding 12 months. Transactions that meet requirements of Regulation D. Transactions in which the client is an institutional accredited investor. Transactions that are not recommended by the broker-dealer. Transactions in which the customer is the issuer, officer, general partner, director, and so on of more than 5% of any class of equity security of the issuer of the penny stock. Any other transaction deemed to be exempt by the SEC that it deems as consistent with the protection of investors and is the public's interest are all exempt penny stock transactions. Getting preferential treatment. Preferred stock. Equity securities represent shares of ownership in a company, and debt securities will represent debt. Although preferred stock, sometimes simply called preferreds, has some characteristics of both equity and debt securities. Preferred stock is an equity security because it represents ownership of the issuing company the same way that common stock does. Considering characteristics of preferred stock. One advantage of purchasing preferred stock over common stock is that preferred shareholders receive money back, if there's any left, before common stockholders do if the issuer declares bankruptcy. However, the main difference between preferred stock and common stock has to do with the dividends. Issuers of common stock pay a cash dividend only if the company's in a position to share corporate profits. By contrast, issuers of preferred stock are required to pay consistent cash dividends. Preferred stock generally has a par value of $100 per share, although it could be $50, $25, and so on, and tends to trade in a market somewhere close to that par value. However, like debt securities, the price of preferred stock will increase or decrease based on changes in prevailing interest rates. Because preferred stock receives or are supposed to receive a consistent dividend, they are somewhat like debt securities receiving interest. Because of that similarity, like debt securities, bonds, many preferred stocks are rated by rating agencies such as Moody's, Standard & Poor's, and Fitch. Some of the drawbacks of investing in preferred stock over common stock are the lack of voting rights, the higher cost per share, and limited growth. You can assume for Series 7 exam purposes that preferred stockholders don't receive voting rights unless they fail to receive their expected dividends. A few other expectations exist, but you don't need to worry about them now. Also, because the price of preferred stock remains relatively stable, preferred stockholders may miss out on potential gains that common stockholders may realize. If the issuer can't make a payment because earnings are low, then in most cases, owners of preferred stock are still owed the missing dividend payments. The dividend sharing profits that preferred stockholders receive is based on par value. Thus, although par value may be nothing more than a bookkeeping value when you're dealing with common stock, par value is definitely important to preferred stockholders. To calculate the annual dividend, multiply the percentage of the dividend by the par value. For instance, if a customer owns a preferred stock that pays an 8% dividend and the par value is $100, you set up the following equation. 8% preferred stock times $100 par equals $8 per year in dividends. If the issuer were to pay this dividend quarterly every 3 months, an investor would receive $2 per share every 3 months. When working on a dividend question on preferred stock, you need to look for the par value in the problem. Remember, it's normally $100, but it could be $25, $50, and so on. Getting familiar with types of preferred stock. You need to be aware of several types of preferred stock for Series 7. This section gives you a brief explanation of the types and some of their characteristics. Some preferred stock may be a combination of different types, as in cumulative convertible preferred stock. Here are the distinctions between non-cumulative and cumulative preferred stock. Non-cumulative straight preferred. This type of preferred stock is rare. The main feature of preferred stock is that investors receive a consistent cash dividend. In the event that the issuer doesn't pay the dividend, the company usually still owes it to investors. This isn't the case for non-cumulative preferred stock. If the preferred stock is non-cumulative and the issuer fails to pay a dividend, the issuer doesn't owe it to the investors. An investor may choose non-cumulative preferred stock over common stock because the company is still supposed to pay a consistent cash dividend. Non-cumulative preferred stock is riskier for investors than cumulative preferred stock, so the issuer typically offers a higher dividend. Cumulative preferred stock is more common. If an investor owns a cumulative preferred stock and doesn't receive an expected dividend, the issuer still owes that dividend. If the issuer declares a common dividend, the issuer first has to make up all the delinquent payments to cumulative preferred stockholders. The following question tests your understanding of cumulative preferred stock. An investor owns ABC 8% of cumulative preferred stock, $100 par. In the first year, ABC pays $6 in dividends. In the second year, it paid $4 in dividends. If a common dividend is declared the following year, how much must the preferred stockholders receive? A, $6, B, $8, C, $12, or D, $14. The right answer is choice D. Because ABC is cumulative preferred stock, issuers have to catch up preferred stockholders on all outstanding dividends before common shareholders receive a dividend. In this example, the investor is supposed to receive $8 per share in dividends, 8% times $100 par. In the first year, the issuer shorted the investor $2. In the second year, $4. The investor hasn't yet received payment for the following year, so they are owed $8. Add up these debts. $8 minus $6 plus $8 minus $4 plus $8, which equals 2 plus 4 plus 8, which equals $14. All preferred stock has to be either cumulative or non-cumulative. Both types have other features, including the ability to turn into other kinds of stock, offerings of extra dividends, and other VIP treatment. I'll run through some of these traits in the list that follows. Convertible preferred. Convertible preferred stock allows an investor to trade their preferred stock for common stock of the same company at any time. Because the issuers are providing investors with another way to make money, investors usually receive a lower dividend payment than with regular preferred stock. The conversion price is the dollar price at which a convertible preferred stock par value can be exchanged into a share of common stock. When a convertible preferred stock is first issued, the conversion price is specified and is based on par value. The conversion ratio tells you the number of shares of common stock that an investor receives for converting one share of preferred stock. You can use the following conversion ratio formula for convertible preferred stock and also for convertible bonds. Conversion ratio equals par value divided by conversion price. The conversion ratio helps you determine a parity price where the convertible preferred stock and common stock would be trading equally. For example, say you have a convertible preferred stock that's exchangeable for 4 years of shares of common stock. If the convertible preferred stock is trading at $100 and the common stock is trading at $25, they're on parity because the 4 shares of stock at $25 equal $100. However, if there's a disparity in the exchange values, converting may be profitable. If the convertible preferred stock is trading at $100 and the common stock is trading at $28, the common stock is trading above parity. Converting makes sense because investors are exchanging $100 worth of securities for $112 worth of securities, or $28 times 8. A callable preferred stock allows the issuer to buy back the preferred stock at any time at a price on the certificate. And this stock is a little riskier for investors because they don't have control over how long they hold the stock. So corporations usually pay a higher dividend on callable preferred stock than on regular preferred stock. Issuers will issue callable preferred stock with a striking fund provision, which means that the issuer will set aside money in an custodial account, to repurchase the shares if they decide to sometime in the future. Participating preferred. Although rarely issued, participating preferred stock allows the investors to receive common dividends in addition to the usual preferred dividends. Most preferred stock is non-participating, meaning that they don't receive common dividends, only preferred dividends. Prior senior preferred. Preferred stockholders receive compensation before common stockholders in the event of corporate bankruptcy. In this case, senior preferred stockholders receive compensation even before other preferred stockholders. Because of the extra safety factor, senior preferred stock pays a slightly lower dividend than other preferred stock from the same issuer. Adjustable, variable, or floating rate preferred. Holders of adjustable preferred stock receive a dividend that is reset every 3 months to match movements in the prevailing interest rates. Because the dividend adjusts to changing interest rates, usually based off of certain benchmark, such as the T-bill rate or London interbank offer rate, the stock price remains more stable. The following example gives you an idea of how to determine the conversion ratio. If ABC preferred stock $100 par is convertible into common stock for $25. What is the conversion ratio? A. 1 share. B. 4 shares. C. 25 shares. Or D. 100 shares. The answer you want is choice B. This equation is as simple as math gets on a Series 7 exam. Because the $100 par value preferred stock is convertible into common stock for $25, it's convertible into 4 shares. Conversion ratio equals par value divided by conversion price, which equals $100 divided by $25, which equals 4 shares. If you securities with a twist. Some securities will fall outside the boundaries of the more normal, common, and preferred stock, but I will include them in this equities chapter because they involve ownership in the company or the opportunity to get it. This section gives you an opportunity of those preferred special securities. Open international borders. ADRs. American Depository receipts are receipts for foreign securities traded in the United States. ADRs are negotiable certificates. They can be sold or transferred to another party that represent a specific number of shares, usually 1 to 10 of a foreign stock. ADR investors may or may not have voting privileges. U.S. banks issue them. Therefore, investors receive dividends in U.S. dollars. The stock certificates are held in a foreign branch of a U.S. bank, the custodian bank, and to exchange their ADRs for actual shares, investors return the ADRs to the bank that's holding the shares. In addition to the risk associated with stock ownership in general, ADR owners are subject to currency risk. The risk that the value of the security may decline because of the value of the currency of the issuing corporation may fall in relation to the U.S. dollar. For example, how the strength of the dollar affects the relative price of goods in an international market. Stay tuned. Rights. The right to buy new shares at a discount. Corporations offer rights, subscription or preemptive rights to their common shareholders. To maintain their proportionate ownership of the corporation, rights allow existing stockholders to purchase new shares of the corporation at a discount directly from the issuer before the shares are offered to the public. Stockholders receive one right for each share owned. The rights are short-term, usually 30 to 45 days. The rights are marketable and may be sold by the stockholders to their investors. If existing stockholders don't purchase all the shares, the issuer offers any unsold shares to a standby underwriter. A standby underwriter is a broker-dealer that purchases any stock that wasn't sold in the rights offering and then resells the shares to other investors. For Series 7, you can assume that common stockholders automatically receive rights. Because rights allow investors to purchase the shares at a discount, rights have a theoretical value. The board of directors determines that value when they decide how many rights investors need to purchase a share, as well as the discounted price offered to investors. To determine the value of a right, you can use one or more basic formulas. The cum rights formula or the X rights formula. The cum rights formula or the X rights formula. Look closely at the question to determine which one you need. The following sections explore each. Listen up. Using the cum rights formula, you may have to find the value of a right while shares are still trading with the rights attached. To find out how much of a discount each right provides, you can simply take the difference between the market price and the subscription price, divide that by the number of rights, and come up with a price with a nice round number. But not so fast. On the X date, the first day that the stocks trade without rights, the market price will drop by the value of the right. And for the X day, you can find the value of the right by using the cum Latin for with rights formula. Value of right cum rights. Value of a right cum rights. M for market price minus S for subscription price divided by N for number of rights needed to purchase one share plus 1. The plus 1 in the denominator accounts for the later drop in the market price. Try out the following rights question. Def Corp is issuing new shares through a rights offering. If a new share costs $16 plus 4 rights and the stock trades at $20, what is the theoretical value of a right prior to the X date? A. 20 cents. B. 80 cents. C. $1. D. $1.20. The right answer is choice B. The stock is trading with cum rights. The words prior to the X day and the problem tip you off. So you need to use cum rights formula to figure out the value of a right. $20 minus $16 divided by 4 plus 1 equals $4 divided by 5, which equals 80 cents. Using the X rights formula, when you calculate the value of a right on the X date, the first day the stock trades without rights, the market price has already fallen by the value of the right. You simply have to use the new market price and subscription price to figure out the discount per right. If the stock is trading X rights, use the following formula to figure out the value of a right. The value of a right, X rights. M for market price minus S for subscription price, all divided by N for number of rights needed to purchase one share. some rights and X rights formulas are the same except for the +1 in the denominator. Because X means without, remember that the X formula is the one without the +1. Warrants. The right to buy stock at a fixed price. Warrants are certificates that entitle the holder to buy a specific amount of stock at a fixed price. They're usually issued along with a new bond or stock offering. Warrant holders have no voting rights and receive no dividends. Unbundled bonds and warrants, or bundled stock and warrants, are called units. Unlike rights, they have a long term and sometimes perpetual without an expiration date. Warrants are sweeteners because there is something that the issuer throws into the new offering to make the deal more appealing. However, the warrants are marketable securities. However, the warrants are marketable securities and can be sold separately on the market. When warrants are originally issued, the warrant's exercise price is set well above the underlying stock's market price. For example, suppose QRS warrants give investors the right to buy QRS common stock at $120 common stock at $20 per share, when QRS common stock is trading at $12. Certainly exercising their warrants to purchase QRS stock at $20 wouldn't make sense for investors when you can buy QRS stock in the market at $12. However, if QRS rises above $20 per share, holders of warrants can exercise their warrants and purchase the stock from the issuer at $20 per share. When a corporation offers new stock through a rights offering or by issuing warrants, the corporation includes an anti-dilution agreement or anti-dilution provision in its corporate charter and prospectus. The anti-dilution agreement states that if the issuer offers new securities to the public, it must offer them to its current stockholders first. This allows its existing stockholders to keep the same proportionate ownership of the issuing corporation.